This is Danny Bobrow, President of AIM Dental Marketing, welcoming you to this installment of the Practice Perfection Web-Based Education Series. Today's webcast is titled Dental Cash Flow for Dummies and will be presented by Rick Willeford, MBA CPA. Why is it your CPA says your practice made a profit last year, but your bank account says otherwise? Does it take months before he or she can even tell you that? This event will help put you back in control and unlock the power to chart your practice's destiny. Rick was a dental CPA for 40 years. He has been an avid writer for dental economics and is an internationally sought-out speaker. After he sold his CPA practice, he immediately dusted off his electrical engineering degree from Georgia Tech to develop DentaMetrix, a professional-grade data extraction and dashboard program for consultants, DSOs, experienced practice administrators, and, of course, dentists. The combination of his knowledge of cutting-edge technologies, his deep dental business experience, and his understanding of the practice management side of dentistry give him a unique perspective to enhance revenues and plug profit leaks in a practice. And as an attendee at today's presentation, you will learn why most traditional financial statements are not ideal for running a dental practice, understand the difference between cash flow and profit, unlock the secret powers hidden in your practice's financial reports, and turn your accounting software into a dental practice management dynamo. Today's event will run for around 90 minutes. While attendees are in listen-only mode, we invite all of you at any time to submit your questions or comments using the question button on your screen. We will allow time following the presentation to get your questions answered. If we do not get to your question during the webcast, we'll see that it's answered shortly thereafter. Attendance at this presentation entitles you to apply to receive 1.5 hours of continuing education credit. Shortly following the webcast, we will send you an email with instructions for receiving your CE. Please note that the code for this course is WIL 042822. That's WIL 042822. You will need this code to request your CE, so please be sure to write it down. And now, it is my distinct pleasure to welcome to the Practice Perfection stage my friend and colleague, Mr. Rick Willeford.
Thank you, Danny. I think you're going to get some really useful information tonight, not just theoretical. I think I would go as far as to say it's exciting as far as the accounting world goes, but remember, as a CPA, my bar for the level of exciting is pretty low. But I think you really will.
Well, keeping money is exciting for anybody, though.
I wanted to mention, too, that this is a great course for your practice administrators if you're in a dental practice or a consultant. And we've got some of my CPA buddies tagging along here. This would actually be good for some of their junior accountants, because even in the accounting world, for some reason, this is always a difficult concept between cash flow and profit. We answered these same questions every year for 40 years, and it still somewhat befuddled us. Had to pause for a second to make some explanations. So I've got some interesting things for us to go over tonight. Well, it'd be interesting if it would move. Hang on just a second here. We're going to do the cash flow versus profit as advertised. A lot of people don't understand that. And frankly, it scares them to look at a profit and loss statement just because there's so much stuff there. So I'll show you how we overcame that finally. So I'm going to call it Show Me the Money. We're going to have a report for you that's actually graphical, where you get 90% of the bang with 10% of the effort. At the end of the program, that's one of the items I'll be offering. If you want me to send you a copy, send it to me, and you can copy that and recreate that in your own Excel if you want to. The third bullet point, though, here is to take your profit and loss out of QuickBooks, say, or whatever your CPA gives you, and get them perhaps to consider redesigning that, not much, but into a format that actually would help you manage your practice. So we'll look at that in some detail. That's another item I'm happy to share with you. Shoot me a note at the end, and I'll get you what we'll call the chart of accounts, or what creates the format of the layout in QuickBooks. And then if we have time, I want to show you graphically what in the world is break-even point all about. We've heard about that, but it's an interesting way to look graphically is what's the effect of PPOs and the reduced reimbursement on your break-even point. So do jump in with some questions in that chat box to Danny, and he's authorized to use his judgments to bring the conversation to a halt if it looks like it's a hot topic, or he can collect those and we can answer them as we go along. So I'm going to jump right in then. Here's what the office's perception is. We're just leaking money everywhere. We've got to be leaking money because we don't have any money. We got plenty came in the front desk, but where in the world did it go? Well, we want to help you patch those leaks up. So let's see what's going on and prove to you that it may not be as bad as you think, or it may be as bad as you think, but let's help identify specifically what's happening. Life should be simple. We have collections minus expenses coming in, operating expenses, staff, supplies, etc. And then we have the doctor's fringes and wages and things like that. So collections minus all these expenses, when we get down to the last bucket, we ought to have net income or profit left over. So why isn't it just that simple? Well, the IRS and Congress doesn't like simple. They want to use the tax code to move the economy around. You may recall once in a while they'll make it easy for you to buy equipment and depreciate it quicker, if not even in 1 year. And that's their way to speed up the economy, or they could slow it down. So they don't like simple. The fact is, you and your CPA don't like simple. I could create a simple handpiece for you, doctor, that would save a lot of money. The only problem would be you can't ever change the burr. Well, what the heck good is that? Well, you said you wanted simple. Just like if we welded the tires onto your car and you couldn't take them off with lug nuts, that'd make it simple. Your CPA does not like simple, especially if he's sophisticated in the tax world. And most of your dental CPAs should be, because they understand the tax world and your operating world, what's going on. They realize that a CREC machine costs north of $100,000, or whatever the number is these days. Most general CPAs may have one or two doctors. They'll have a mattress manufacturing company. They'll have a jewelry store. And to them, there's nothing in a dental practice that costs $100,000. So their knee-jerk reaction is always to say no if you ask if you should get one. Well, as a dental CPA, we actually went to the headquarters of the E4D, which was a competitor to CREC, down in Texas, and we wanted to understand this machine. We don't just hang around at our annual meetings and talk about taxes. We want to talk about taxes as they impact dentists. And so there are several ways we can handle writing off, deducting $100,000 plus expenditure you make, and we enjoy that fact. We can write it off quickly, we can write it off slowly, we can match it to your other revenues, your other income. So we don't like simple either. We like to have complexity, and that's where we can do our magic. But you don't need to know how the sausage is made. Most doctors, they just want to know what the time is and not how the watch was made. But I just wanted to let you know there's a reason for what looks like lack of common sense when we compare the real world, that is money in your checkbook, versus what Congress declares as your taxable income. And here's what happens. Between the operating expenses, we know what rent is, we know what supplies are. Congress inserts something called depreciation. This is where they time how quickly or slowly you have to write something off over its lifetime, perhaps. Economic lifetime of a dental chair might be 20 years or so. They're not going to let you just write it off tomorrow, but they will in certain circumstances, and that's what your CPA understands. But the problem they've created for us here is, and we call this accounting or paper profit at the end, but the problem is nobody in the room has ever written a check to depreciation. And that's where the trouble begins. All of a sudden, our cash in the bank is different from this accounting profit, paper profit, net income, whatever you want to call it. And so that's where we all get confused because we use the terms loosely down here of profit and net income, but to the IRS and a CPA, that has a very precise meaning. And it involves this kooky depreciation thing in here. So what we suggest is, let's get rid of that imaginary depreciation, and that's in fact a very valuable deduction. And we love depreciation, but it does mess up the understanding. But notice, on the other hand, your profit and loss statement does not include your loan payments. You're making $8,000 payments to the bank maybe for your equipment loan, and your profit and loss statement only shows the interest portion as a deductible expense. And that's what Congress intended. So now we're falling over the other side of the fence. Now we're missing payments where we actually did write a check. And this is what we want to unwind here. Just kind of straighten it up here to align all the margins. So we have collections minus operating expenses minus loan payments, and then minus doctor's fringes is no longer called net income or profit, but we would technically call that net cash flow. And that would make sense. But let's go one step further. If I want to compare your practice to the practice next door and the practice down the street, it may be that you have decided to put your BMW in your corporation and write that off as an expense. Hopefully you're traveling somewhat between offices maybe for business, but somehow you've convinced your CPA to deduct that for you. But what if the guy down the street doesn't have a BMW in the practice? And so his numbers will look totally different than yours, unrelated to how your two practices are operating. Also, you may get aggressive and decide to put 3 kids on the payroll. It just happens you pay them enough to fund their own Roth IRA. The guy down the street doesn't know to do that. And so again, your numbers differ, but not due to true overhead and operating expenses, just some of the, quote, games you're playing. And so what I want to do to help you compare to others and your CPA to compare to others is figure out what's the net operating cash flow, that is after our, quote, real expenses, staff, supplies, loan payments. Let's get the net operating cash flow, and we're going to ignore for the moment doctor's fringes, wages, automobile, kids on the payroll, etc. I'll comment on that a little bit later. But the key is net operating cash flow would be fairly comparable across offices. In fact, you could go one step further. Your equipment could be paid off, another person is not, and so you may not even have loan payments, but it's easy enough to adjust for that. So that's how we're going to adjust the big picture, and I want to show you what that ends up looking like in our graphic model. Get my screen working here. And so again, we're going to knock that out. Don't have a brain explosion here. This is the 2-page report I'm going to give you a copy of later, and I'm going to dive down and zoom in on some of these pieces. I just wanted to give you sort of a frame of reference of where we're going for the next 4 or 5 slides. So let's zoom in here. what I want to do, first of all, is show you pictures. I like pictures, even as a CPA, more than columns of numbers and numbers and numbers. There'll be plenty of numbers we'll look at in a minute, but I like the pictures. And here's what we're showing you. The red area, that's how much you spent on the team. Gold is supplies plus lab. That's your variable expenses. We'll talk about in a bit. The light green is your facility. Blue is what we'd call general administrative. That's where your accounting, bank charges, e-file fees, things like that are. And this little sliver down at the bottom here would be your loan payment or your lease payments if you're leasing equipment rather than buying it. And so you may or may not have that. And there's one other piece we're going to talk about, and that's where do we put dental associates. This particular example doesn't have any, but if they did, they'd be right here below the red. And we'll talk about why that is. And so if we look at our overhead here, adding it all up, the height of these 5 or 6 items looks pretty steady. So practice management wise, the accountant or your practice administrator, your consultant, is very excited. It says, Doc, you're doing great here. You're actually on the money. You may be a little below budget on your expenses, so that's fantastic. Let's move on to the next topic, maybe recare or something like that. And invariably, of course, the doctor is going to interrupt and say, but I don't have any money. Oh, well, doctor, in fact, your overhead is just right. You're hitting on all cylinders, and see all this green? That is the money it generated for you. So this is your share of the money. But I'm looking at your share of the money not in a narrow sense, not just what's my W-2, how much profit did I take home? Let's say you have a K-1 and an S corporation. But here is where we also make you put, I'll call it loosely, how much money you're stealing from yourself. And that is the BMW goes here, your retirement plan goes here, your 3 kids on the payroll go here. You may have spent $10,000 to go to Hawaii, and you convinced your CPA that was the only place to get a quality annual CPR certification, so you had to go to Hawaii. Well, we'll wink, wink, nod, nod. We'll call that continuing education, but don't insult us and call that true overhead. Don't be beating up on your practice administrator if they're in charge of watching the overhead. For tax planning purposes, we'll let you call that continuing education, but we'll probably actually put that in a different place on your financial statements. We'll see in a little bit, so you don't confuse anybody. So you did generate a bunch of green. Now, if you don't have any money, it sounds like you've probably got to look in the mirror, ask spouse, doctor, try to figure out where in the world you're probably, frankly, overspending. The good old American way. But don't be fretting about your overhead, because 90% of your problem is rarely overhead. Okay? And so to me, I would love every CPA out there to not force you to look through that QuickBooks P&L every month or so. Just like I would ask you, please, please don't force your patients to look at all those grainy x-rays and try to follow the conversation. Instead, I'd like to see them generate this net operating cash flow for you every month. I think it'd be pretty easy to understand then if one of your major categories was out of line or not. Easier than watching the profit and loss that has that depreciation in there, doesn't have the principal on your loan payment, things like that. Now, that does not mean the P&L, profit and loss statement, is useless. Far from it. Your CPA needs the profit and loss statement to do tax projections for you, which I hope you're doing a couple of times a year to avoid surprises on April 15th. However, the profit and loss was designed to do a tax return. Cash flow is designed to help you manage your practice. And frankly, a consultant and even the CPA would love this as well, so they wouldn't have to keep explaining to you why this profit per your P&L differs from your money that you see. While we're at it, I'm suggesting that there are two ways you could measure overhead. Neither's right nor wrong, but many times you're using the wrong approach for the objective you're after. So here's the year-to-date overhead by percent. Here was the goal. Here's the actual year-to-date. They're doing better. And you're thinking, whoa, wait a minute, Rick, you're happy with whatever 75% overhead here? And a goal was up here approaching 90%? Here's where we get into how are you measuring your overhead. 95% of the world measures your overhead based on collections. And we'll have a lot of food fights with your practice administrator and others as we argue whether this should be based on collections or production. And I said in the right circumstances, both could be helpful. I'll show you an example with more detail in a moment. Most people base it on collections because, one, they say I pay overhead with collections. That's true, but I'll be continually reminding you production is what generates overhead, creates overhead in the first place. You're left with whatever collections you have to pay the overhead the production created. Also, this is a huge PPO practice. We'll see in a moment in my example, we're going to have a big gap between their production and their collections. But most folks use collections because that's the easiest way that QuickBooks is set up. Most of your CPAs are set up to show it as a percent of collections. In your own office, that's just fine if you know that this should be our goal based on our collections, which is different than the guy next door. But internally, from month to month to month, you'd have your goal possibly set up on percent of collections. And here we're also showing it to you by raw dollars. And this green was that profit we talked about, or the doctor's economic benefit. But in our program called DentaMetrix, and that's where this particular slide comes from, but you don't need DentaMetrix to do this. I'm going to give you this slide later on so you could put this together with your manager in your own Excel. But what we do is, rather than get in this fight, why don't we show it both ways? I know what your production is. I know what your collections are. So I can take your overhead and I could put 100% as your gross production or 100% as your collection, and you break it out down here. But look at the huge difference it makes. 48% overhead based on production, 75% based on collections. Quite a different swing based upon how you measured this. If you want to compare yourself to reputable peer-reviewed national statistics, you'd need to rework your numbers to be a percent of gross, because everybody, we can compare UCR standard fees across the board. Whether you're in a PPO or not, that's your problem, and how do you collect the difference, etc. But we can always agree on the UCR standard fee and calculate our numbers that way. So if you have a good article from Dental Economics or whatever, and those articles are getting difficult to interpret sometimes because everybody is self-reporting and you have no idea how did the guy down the street report his percentage of overhead. And we know it's probably, sadly, going to be based on collections. But I'll bet if you work with a dental CPA or a CPA who has a lot of dentists, he's going to pull together his own numbers. And she will show you, based on whatever, 100 practices, and doing it properly, comparing gross to gross to gross to gross. Here's what your numbers woulda, coulda, shoulda been if you were a fee-for-service practice. Whole different wrinkle if you're a PPO practice. Let me show you an example. Are we going to do overhead based on collections versus production? So let's say we have two offices that are both collecting $1 million. One has dental supplies of $60,000 or 6%, and the other has dental supplies of $90,000 or 9%. This doctor, I'm telling you, is always in a foul mood. He remembers years ago, he was always told 6% is the magic figure. So either people are stealing supplies, wasting supplies, or that sorry supply salesman is overcharging you. For some reason, we're out of line here. Well, let's take a little further look. This is a fee-for-service practice. This is a PPO practice. For a fee-for-service practice to collect $1 million, we'll forget 98% collection ratio. We'll say he collects it all. He only has to produce $1 million to collect $1 million. Look at the poor PPO guy, though. To collect $1 million, he's got to produce $1.5 million. And of course, every PPO practice figures are different because we don't know what percent of your production comes from PPOs. 20%, 40%, 80%. That's why it's useless to try to compare across PPO practices because there's a differential of how much PPO participation they have. But look what happens here. If you take your dental supplies, 60,000, as a percent of UCR, there's the 6%. But look what happens if you divide the 90,000 by the 1.5 million, son of a gun. You're at 6%. That's why this number is important to you based on production at standard fees at least once in a while, so you can play in that same sandbox and compare numbers with your CPA's other dentists or guys in your study club or whatever. If you explain to them, please reconstruct your overhead based upon production. Because remember, what's going on here? Why is this guy spending $90,000? Well, he has to do $1.5 million worth of dentistry. This guy only has to do $1 million. And so he needs more supplies, more staff, more chairs, et cetera, to feed the PPO monster. And this is why we and your CPAs and folks like Gary Takis and Danny are saying, guys, can we please talk? We've got to get out of these PPOs if it's at all feasible. And we have ways to talk about doing that. And we have case study after case study after case study where this has been done successfully with some planning. You don't just all of a sudden Monday drop all the PPOs, but with some communication and things like that for the time period leading up to when you decide to drop this. We want you to have an extra 2-minute conversation with each patient for the next 6 months, 8 months, whatever it takes to get through a cycle. Ms. Jones, you've been with the practice for 15 years. We want to say we just really appreciate that and the fact that you have trusted us with your dental care for 15 years. And we want to assure you you can always trust us, because I know you hear some strange things going by out there from some of your neighbors who are getting some odd diagnosis, it seems like, to them, where they walked in with just a toothache and they walk out with 4 crowns suggested to them. And by the way, if you have a good neighbor, good friend who's run into that kind of situation, send them over to us. And since you're such a good patient, as a complimentary visit, we'll give them a second opinion and see if that's on the mark. I mean, there are ways you can spend $30,000, $40,000, $50,000 on a mouth that's really in pretty bad shape. But in many cases, we find you could probably get 85% of the benefit and maybe spend less than, say, $10,000. Still may not be cheap, but 10 is a lot less than 50. And so again, you being a good patient, we would love to look at any of your friends or neighbors and help them see if that diagnosis makes sense. So does this make sense to you, the argument of doing the overhead based on collections versus production? Again, I have no problem basing it on collections if you're a PPO practice, but recognize your budget would be 9%. Stop getting a hernia and trying to get down to 6%. That 6% is a pipe dream from the past when there were no PPOs. That's when you collected 98% of what you produced, like the fee-for-service column, and that's why 6% is fair, okay? But if you and your accountant sit down and budget 9%, there's a great sigh of relief. You're not overspending. It's just based upon the peculiarity of your math and the fact that you have a huge difference between your production at standard fees and collections. And about 4 years ago, the software, the DentaMetrix, EagleSoft, the World, etc. Before 4 years ago, if you wanted your full fee to be billed to Delta, let's say back then it was a $1,200 crown fee, you had to post that to your computer system, to your DentaMetrix, EagleSoft, and to the patient ledger, so they knew what to bill Delta. Everybody knew Delta was only going to pay you whatever, $700 or $800, but they had to go through that game of posting the full fee. Well, about 4 years ago, they wised up and did what we've done all along. Doesn't DentaMetrix already know what your standard fee is for a crown? Duh, $1,200. They know that already. So why don't they just automatically bill that, or whichever other type of crown you produced? Let them bill that to Delta. You don't have to tell DentaMetrix or EagleSoft to do that for you. And so what that does is it frees you up to say, whew, why don't we stop all these write-offs at the front door when the EOB comes in and all the bookkeeping hassle, and maybe politically having a conversation with the patient. And so probably a third, maybe as many as a half of the offices now got lazy. I got no problem being lazy. If you want to be lazy, though, you got to be smart. And they're allowed to post the net PPO fee, let's say $700, to the patient. And so they don't have to make those huge $500 write-offs on the EOB when it comes in. So they relax and life is good. The problem is that nowhere do they write down that $500 differential. In the old days, you used to have to post an adjustment, $500. Oh my gosh. At the end of the year, that number would slap you in the face. Well, in DentaMetrix, we know your standard fee schedule. We track that number for you, and whether you like it or not, we're going to continue to gently, or sometimes not so gently, rub your nose in that and remind you, doctor, you realize with the drop in reimbursements that the largest expense item in your office doesn't even appear in your QuickBooks if you choose to post the net PPO fee to your patients. If we could have had you post the UCR fee like in the old days and then posted manually your adjustments when the EOBs came in, you might discover you left $500,000 on the table by being in the PPO. Has that got your attention yet, doctor? And so we have charts and graphs and pictures in DentaMetrix where we plot that for you, and we do it even by carrier. What's that graph look like for Delta versus Aetna versus MetLife? And we can see which of the PPOs are more or less profitable, and you can do an analysis of maybe which are the worst PPOs you're in. So I hope this makes sense, that you can do it either way, collections or production. But if you're going to try to compare to other dentists in your study club or that your CPA has, you all have to agree, even if you have to go back and very quickly manually calculate this. Guys, let's make it all based on gross production at UCR fees and see what our percentages are. Internally, you can do it either way you want to, but recognize if you post to your practice and you're going to have 9% overhead for your dental supplies, but that could be an appropriate number for your practice. So don't lose sleep over it, but don't try to compare that to the 6% that's over in the fee-for-service column. So you can argue both ways. Both ways can work. But again, for external comparison, we've got to use the gold standard and all measure against UCR fees because we don't know how everybody in your study club, what percent are in PPOs. So we just have garbage in, garbage out here, and you get all kind of weird percentages. I heard one speaker at a conference say that we're watching the overhead guys, and now we're seeing dental supplies at 9.3%. And I said, gag me. What are you talking about? Of course, I knew what they were talking about. They were calculating the dental supplies based on collections, which is all over the board. So I hate to belabor this point, but this is a big thing for you and your practice administrator to understand. Okay? I'm moving down to the middle section of the chart. Hang on, we're not going to stay here long. I just wanted to show you. We're going to show all the numbers, and we break this up into those categories. This is the team compensation, including hygiene, fringe benefits, etc., supplies and lab, facility, that type of thing. But I wanted to go down to a bottom section. I don't know how many of you guys are familiar with the term Ebitda. This is coming up more and more in practice transition conversations, valuations. In the business world, oftentimes a practice is valued based on Ebitda. Well, you can't see or calculate Ebitda in your practice unless you go through a cash flow analysis and do what we're doing here. Some of your CPAs may be doing that for you. Most solo practices, don't really care. This is kind of over the top, but I wanted to show we do have it here. And a practice oftentimes is worth, say, anywhere from 3 times Ebitda to a ridiculously high number of maybe 10. And this is talking about earnings before interest, taxes, depreciation, and amortization. And so this would really give you a headache to think about, but it is here, and a knowledgeable CPA might find this useful. But I wanted to show you some of the graphs we can put together now, the speedometers. How much are your collections versus your goal? Now we're in the green area. What's your net operating cash flow before the owner? And that's $104,000 versus a goal of $21,000, say. How's your major overhead? This is the real overhead, not your trip to Hawaii, not the 3 kids on the payroll, etc. This is something interesting. How are your collections versus your break-even point? And here's where you can bridge the gap between practice management, that is the patient flow, scheduling, and things like that, and the operations, versus the financial aspects of your life. And I suggest that you look at a break-even, and we'll show this graphically in a bit, not just for the practice, but I'd like to add in your personal break-even. How much money, what's the least amount you can take home to pay your car payments, pay your mortgage, et cetera, your fixed expenses, just like in the office. That's roughly what the practice break-even is. What's it cost before we even open the door in the morning? Primarily our fixed expenses, et cetera. It's not quite that simple because you do have lab fees and dental supplies, your variable expenses that go up as the number of patients come in for the day. But I'd like to add together your practice break-even plus your personal break-even. And it's fun to have a meeting sometimes with your staff in the afternoon and say, staff, I worked with my accountant and we discovered that we don't make any money until after 3:30 in the afternoon. What? What are you talking about? Well, we've got all this break-even expense we've got to cover. And so we really don't make any money till 3:30 in the afternoon and later. That's why that 3:30, 4 o'clock, 4:30 appointment are so important to us. Remember, by the time folks come in at 4 o'clock, all they cost us is a little supplies and maybe some lab fees if we're lucky, but the rent's already paid. Telephone bill's already paid. Staff is already paid. That's the fixed expenses we'll see in a minute. The only thing we have to pay extra would be those variable expenses, lab fees, things like that. But here's another neat thing that nobody ever looks at. It's so simple to do when they say, well, how's my hygiene department doing? Well, in the old days, we would say it'd be ideal if a hygienist produces 3 times what her W-2 is, 3 times what she's paid, and I'm plotting that here. However, can you imagine? I was just in California at a meeting out there. The hygienists are now lobbying for like $60, $65 an hour. And that's barely what a PPO covers for the entire hygiene visit, not to mention supplies, et cetera, et cetera. And so we're in a world of hurt. One more reason it'd be great to get out of PPOs, that there's no way you're probably going to be able to hit this. And the hygienist doesn't want to hear about reimbursement rates going down, et cetera, et cetera. She knows what their friends are making. Why can't I make what they're making? So that's a whole different conversation we have. But this is fun that I already know your production. You've told me your wages through your QuickBooks, hygiene wages, and we can do that ratio, and we'll see this again in a few minutes in a financial statement. So that's the end of what we call our financial flash report, or the net operating cash flow, that we think after you see it a few times it'd be so much user friendly compared to the profit and loss, things like that.
So Rick,
yes,
I don't normally break
any hot questions over there.
Yeah, I don't normally break presenters' continuity, but here's a rhetorical question. Do all practices have the same UCR fee so we can compare apples to apples? No, the only way to compare 2 practices fairly then is to have the same amount of rooms, producers, staff, etc. How would you respond?
Well, yes, we're going to, if you're in New York City, your UCR fee is going to be different than if you were in Paducah. And of course, all the fee schedules say that. All the insurance companies pay that way. So that's a variable. It could be, though, that dental supplies in New York City cost more than what you can get supplies for in Paducah, but probably not that much different, but certainly your staff, things like that, you're going to be paying less wages. But that would be a reason to explain why are my dental supplies 5.5% and why are somebody else's dental supplies 6.5%. You've got to take these other things into consideration, but none of those other things, location, demographics, cost of living, none of those would have as big an impact as that huge reimbursement deduction write-off for the PPO. But yes, it's not still yet a precise science because the fee for service is going to be a little bit different across the country.
Right. Okay. Thank you.
Anything else you want to jump in with?
No, not at this time.
All right, moving right along then.
Keep rolling, yes, sir.
All right, so let's look at a profit and loss statement, P&L. This is homemade sample DMD PC. A guy came into us with a box full of papers and his tax records to do a tax return, and he was kind of sheepish, and he said, you know, I haven't really paid any estimated taxes, but the good news is I'm only showing about $2,600 worth of profit down here. So I should be in pretty good shape. Wouldn't owe much in taxes anyway, so no harm done. So okay, well, that doesn't seem like much profit on $733,000 of collections. So that smells kind of funny. Let's look at your layout of your homemade sample here. This came straight out of QuickBooks when you opened the box, right? Oh yeah, they set it up. I just clicked the box that said doctor, and it came up with this stuff for me. Well, notice one thing here. Your expenses are alphabetized, accounting, advertising, etc., and for a reason. The tax return, if you look at it, in many areas is alphabetized, and so it makes the accountant's job easier to transfer this money over to the tax return. And if we add up all the expenses, why do we care if they're alphabetized or not? And I'll show you in a moment. But again, the big thing down here we're going to come back to later is 2,626 in, quote, profit. This is what I want the overall layout to look like, and we'll get into a little bit more detail here. But this is what I suggest you share with your bookkeeping team or your accountant or your CPA and ask conceptually, can we do something more along these lines? There's no right or wrong way to do this, but the principles are here and they'll understand what we're trying to accomplish, but there could be several ways to rearrange this. First of all, I've taken the operating expenses and separated those from doctors' personal expenses, etc. And a CPA would call this being organized by functional categories. If you had to answer the question, what does your total personnel cost you? Well, you'd have to run around to a half a dozen different places in your profit and loss to pick up, of course, the wages, then the payroll taxes, then the matching payroll taxes, then the workers' compensation insurance, and their health care, et cetera, et cetera. We're saying, wait a minute, why don't we organize all the personnel expenses into one subcategory? QuickBooks can do that. Your CPA can do that. How about production? Here's where I add together supplies plus lab fee to keep it simple. You can drill down deeper and deeper like the layers of an onion if you need more detail. The facility, here's your rent, here's your yard maintenance, here's your security, here would be those kinds of things. So what's it cost the repairs to be in the facility? And if you look at dental economics and certain surveys that are out in the world, you'll see they're generally broken down by these functional categories. If you've ever had a consultant come in, they've got to sit down at the table and manually go through your financials and pull together these categories. Why don't you just redesign your QuickBooks to have these numbers sitting there waiting for you? So we come up with a figure called net income before other. But let's see what's in the other expenses. Here's where your equipment and financing is. You may have interest. The guy down the street doesn't. Here's where we stick an associate. Why in the world is an associate? He gets a W-2, Rick. He's not an independent contractor. Why isn't the associate up there with the personnel? Well, the associate isn't a staff member. The associate is almost a sharing of profit. That is, this doctor, it's $700,000 in production, he could produce all that himself. He doesn't need an associate. But let's say he was doing $1.5 million and he would get a little tired. He could make more money if he does all the $1.5 million in production himself. But he says, you know, I'd rather have an associate come in here and do some of that, and I'll pay the associate some number, $200,000, to do that work, and I don't have to work as hard. I will take home less profit. So you decided to take some of your profit, frankly, and buy some time for yourself and have an associate. So that would come under other expenses. If you had a $200,000, $250,000, $300,000 associate thrown in with your normal personnel, your chairside assistants, well, that blow it out of the water and mess up all the numbers. And again, the doctor down the street may or may not have an associate. So we're still trying to match apples with apples. Here's where that pesky depreciation is. This is an actual P&L type of layout like your accountant would rely on. So there's that depreciation that we would like to get rid of as we do our cash flow analysis. But then they come up with net income before the doctor. And so we want to know, what's the doctor's total economic benefit? See, a doctor can talk out of both sides of his mouth when he's talking to a colleague or to his banker. And the banker may say, hey, doctor, what's your overhead ratio like? He'd say, oh, 60%. Hey, fantastic, you're running a tight ship there. Or if the IRS asks, the doctor could say, oh, man, my overhead is 90-something%. I can barely make ends meet. You guys are tearing me up. And remember, both numbers are correct, depending upon how you define overhead, whether you measured it by collections or production, and what do you include in your overhead. When you're talking to your buddies or your banker, wink, wink, nod, nod, you're not including that CE, that $10,000 trip to Hawaii, or the BMW, or the 3 kids on the payroll. That's where it's part of your economic benefit. In addition to your salary, etc., you chose to take some of your money by taking that trip to Hawaii, making it tax deductible, which is smart as long as it's legitimate. And so you ended up with a trip paid for partly by the government. Same with the automobile. But these items really weren't required to run your practice. These are the items, by the way, when a practice transition person gets involved and they have to do a valuation of your practice. And the value of your practice oftentimes weighs heavily depending upon how much cash flow did you create, not necessarily accounting profit. And so they're going to come up with some huge number of cash flow compared to what you've been seeing year after year after year in your tax return. There's no way I made that much money. Well, if we ignore the tax impact, there is a way, and that's the cash flow we were talking about. But here we're looking at a profit and loss statement, true income. But I would suggest somewhere your accountant set up a category called something vague, like budgeted expenses. And so you'd have 2 CE categories. You'd have the usual nasty CE category, a minimum to keep your license. You have to go downtown to the Holiday Inn, do your CPR. That's a legitimate expense. If somebody was buying your practice, they'd have a similar expense to that. If somebody was buying your practice and half starving to death, I doubt they would go to Hawaii just to get some CE. And so that's where the second CE down here, discretionary CE, budgeted CE, something like that. And so your total doctor economic benefits is all this stuff added together, and we'll look at this again in a minute. So again, this is the high level framework of what we're going after. But let me get into more of a real P&L and see what that looks like. First of all, we always wanted to have fees charged in our P&L. And it's called, in accounting language, we call it a memo entry, because we're certainly not going to add and subtract expenses from it, but this is like a note. We would like to see this in your P&L and not have to go over to your DentaMetrix reports and things like that. And if you're going to track your overhead based upon your gross, notice here's where we have the 100% off to the right here. And since that's in your financial statement, we can do that. Here's your 98.8% collection ratio. Most of your P&Ls start with fees collected because that's easy to get. Your accountant would have to go to a little bit of trouble and make some kind of journal entry, we'll call it, every month to get the production in here just for presentation purposes, but it makes your life and, frankly, the accountant and consultant's life a lot easier to have this all in one place. Okay? Also, it shows me what's the breakdown of doctor production versus hygiene production. We'd love your hygiene production in many cases to be 25, maybe 30% of your total production. So you can quickly see here how close are we to matching that. Here's again at item B where I made this the 100% measuring point. If you concur with me that if you had the data, it'd really be nice to measure your overhead based upon your production, because again, production creates overhead. And here's your 98.8% collection ratio. But notice something else here. I've got your adjustments, and you probably need to redesign your practice management system to get your adjustments correct. I want production adjustments with production and collection adjustments with collections, and most of the systems do not do that automatically out of the box unless you work on those. Look what I did down here under the personnel area. I don't have just personnel expenses. Why don't you break it out by department? Hygienist, business, clinical, your chair side. If you're getting your payroll done by your CPA or by ADP or somebody like that, it's child's play and typically free for them to simply subtotal all the wages based upon the department. So you'd know your total hygiene wages, gross wages, before they're taxed or deducted, etc.
At some point, do you also translate that, or can you present that as a percent? So as another benchmark, what percentage of a hygienist's, the department's production ought to be wages, for instance?
That's where we go back to that speedometer we showed before, but we also have it here because I've got hygiene wages almost $50,000. What's 3 times that? $150,000. They did 140, so that's pretty close. If you get that
about
close,
30%,
there,
about a third.
Yeah, that'd be fantastic. You'd think you died and gone to heaven. A PPO is not going to begin to be able to compare that to collections. You're never going to probably collect 3 times what you're paying the hygienist, and that's why you're ripping your hair out, unless we can get you more to a fee for service. Okay? So by simply entering this information, look at all the tricks you can unlock here with your breakdowns and your multiplier for hygiene, etc. And here's your total personnel expenses, 26.8%. That's right on the money with national averages, including fringe benefits, etc. Maybe 25 to 27% based upon UCR production. Let's go to the next page. Here's your production subtotal. Dental supplies plus lab fees. It gets a little more complicated if you have a CIREC, maybe even an employee who works the CIREC exclusively. And if you want to get real fancy with cost accounting, you could allocate some of that in here to get your numbers properly. But here's the dental supplies at 6.5%. Lab fees, 10.6%. That's perhaps a little high, or is it? What kind of lab cases do you do? Have you gone off to one of these fancy courses that insist you don't want to accept a lab case that costs anywhere less than $450, regardless of what you can afford to charge the patient? So if you're in that end of things, you're going to have high numbers here. What if you simply do a lot of crown and bridge? That could be a good sign, not a bad sign. And we measure that. Charles Blair has what he calls an intensity calculation. He says for every 100 large fillings you do, 3 surface, 4 surface plus, for every 100 of those you do, how many crowns do you do? You'd like to see probably typically 40 or so crowns for every 100 large fillings, and that excludes implant-supported crowns. This is just regular crowns, because if you're talking implant, you're not talking about, Ms. Jones, would you like to save this tooth or go ahead and put an implant in there? No, there was no discussion. You weren't going to put an MOD if the alternative most likely was an implant. So we ignore the implant-supported crowns. But if you're down at 10 crowns for every 100 large fillings you do, I'm not the clinician, and I can't tell you should be doing more crowns, because he'd say, well, my patient didn't need it, and maybe that's the case. I can simply report that on average, doctor, we would see 30 to 50 crowns for every 100 large fillings. And in fact, we have quite a few people who are at 150 crowns per 100 units or fillings. And of course, if you're really heavy into cosmetics, you could be 300 crowns per 100 fillings. So it's all over the map, but that's where you'd have to understand what kind of practice you have. Are you a high-end cosmetic practice doing $40,000 and $50,000 roundhouse cases? Then your numbers will be different than the typical GP who doesn't do anything real special. Ought to be around 30 to 50 crowns a month probably, but many are approaching a little more than 100, and that's not unusual. So that's something interesting for you to know there. And so we have the facility expenses. Here was the rent, repairs, utilities, etc. And so your grand total of major expenses, we call them, is 362. The general and administrative expenses, some folks like to call minor. In accounting school, there's no such thing as major and minor expenses. We kind of lump them all together and say, here's all your major operating expenses. That was about 58% if you base it on the UCR fee, and your net income is about 40%. And so those are good numbers. Let's go on to the next page. We carry this over from the page before, the 298, is that 40.2. Here's the other expenses. Here's that pesky depreciation, $21,000. Here's the interest only, $19,000, but no principal. And so both these numbers are unhelpful for two different reasons. Here's where that associate would have been, not up in operating expenses, but down here closer to the profit, because you chose, you'd rather sit around and not do all the work, and you'll pay a young associate to do some of that for you. Or you're doing such a huge number, you're at 2.5 million, you can't help but have an associate or two or three in there with you. But here comes your budgeted expenses, the meals and entertainment, meetings and travel. Again, you have some meeting and travel to a legitimate continuing education course that's only able to be had in California or Florida, or you're going off to Coyce and Spear and Dawson and Pankey and LVI and those people. So some of that's legitimate, but here's where we might see part of that $10,000 trip to Hawaii in there. So we've got total other expenses, and here we've got net income before owner. That's 33% down here. Here's that 33%. And here's the owner's cash compensation. Salary, perhaps salary for spouse, children, FICA, retirement plan, etc. And so his net taxable income to pay income taxes on is $62,000.
Rick?
Yep.
We did have a question earlier, and this is probably as good a point as any to ask it. Is somebody just said, what do you mean by children on payroll? I guess, this technique is something that maybe you want to flesh out, or just why people do this.
Okay.
Yeah.
So a lot of folks will have children on the payroll. They can do light things, picking up trash or filing pages or whatever. You're looking for some kind of excuse if the IRS ever showed up and asked, why are you paying these kids? But there are things they could be doing around the office. And one of
I
our
didn't
folks,
realize it at the time, but my dad, who was a dentist, had me work for him when I was in high school. It was like on, I almost said work release, but it was work study. It felt like work release since I didn't like school that much. But I never realized, that was part of the motivation.
And how much of that did you see as money in your pocket?
That's an excellent question. I don't recall. That's probably why it wasn't much to recall.
You might have gotten, over the year, a couple of $100 of mad money, but the practice, your dad took a deduction for some number, $5,000, a true legitimate W-2. He paid you. You never saw it. It went into your college account or whatever. And back in the early days,
I saw it eventually. But yep, that's what he did. He planned for my college. I didn't pay much for college, I'll tell you that.
Yep. And back in the early days, you were taking money out of his whatever tax bracket he was in, 30 or 40%, and sticking it in your, 10% tax bracket. So he immediately saved money. The IRS finally closed that down a number of years ago. But what they can do is you could pay the child magically, happens to be about $6,500 a year maybe. And that just happens to be the same amount a child could put into a tax-deductible Roth IRA. And they have so little tax that it's smart to put that in there and let that accumulate for the rest of their lives. So there's definitely some tax planning to be involved with there. And if you ask their CPA,
I'd say whoever asked that question should talk to their CPA because there may be an opportunity there.
So you should all be asking your accountant, hey, I heard there's some way we could perhaps wisely and responsibly put our children on the payroll. And if the CPA has a blank look, that's strike number one. He better not have a blank look, because that's part of the complication I mentioned that a CPA likes about the tax code. He knows how to weave his way in and out. He knows where to draw the line between aggressive and reckless and going to jail and those kinds of things. So yes, that'd be a conversation definitely to have. But notice I'm going to show net taxable income of $62,000 on the tax return. Do you remember how much the doctor thought he had? About $2,600 when he first came in, and was sheepishly saying he had not paid any estimated taxes, but assumed he was probably okay. Do you think he's going to be unhappy with the CPA when they announce, hey man, you made $62,000 of taxable income, and here begins the battle, by the way, of the difference between cash flow and profit. And I'll show you that again in just a minute. But the doctor thinks he only made $183,000 here. That's his cash compensation. I say, wait a minute. You had $11,000 you kind of got creative with, the BMW, things like that, the 3 kids on the payroll, and all that profit, the $62,000, that's yours too. You really made $257,000 of economic benefit. In other words, if he went to work for General Motors or a DSO, all this stuff would come out of his pocket. And there's no way he's going to make $257,000. All of a sudden, he loses the tax deduction for some of his travel, his automobile, the kids on the payroll. He doesn't have any profit. That profit probably came largely from the hygiene department, and the DSO keeps that. And that's what we have to go through with guys who think they're going to make a gazillion dollars going to work for the DSOs. You forget, doctor, you're only going to get paid some percentage and only on what you do. Now, you're getting all the profit off the hygiene department. And as the owner, you can wink, wink, nod, nod, bury some expenses that you'll have to pay on your own. So that's a different conversation to have as you're looking at this big check they're dangling in front of you as to what they're not going to pay and you're going to have to take out of your check, which you're not used to doing. So there's that $62,000 I'm going to show on the tax return. He's got total economic benefit of the $257. But let's go back to where we were that started the whole conversation. Cash flow versus net taxable income. Here's the taxable income we're going to report to the IRS. But we're going to take that $21,000 deduction for depreciation. We love that deduction, by the way, but it kind of messes up our checkbook. So we're going to add that back. We didn't really write a check for that. And here's some payroll taxes might have come from a prior period or whatever. But then we're going to subtract the fact that you paid $15,000 extra on your equipment loan. You thought you were helping with your tax planning, but that's not deductible. Not necessarily. That's part of the principal on your loan. You repaid principal of $56,000 to the bank on your equipment loan, but you only showed a little bit of profit up in the tax return. Nobody gave you credit for this $56,000 you paid back. You took an advance to yourself of $12,000. That's not deductible. That's just taking profit sort of in advance. So we subtract these things from the $62,000, and we end up with change in cash or cash flow. There's that $2,626 the doctor brought in. He had accidentally created a cash flow statement. He didn't include depreciation. He had no idea what that was. He never wrote a check to that. He threw in his entire loan payment, principal plus interest. That only makes sense. So he accidentally created a cash flow statement, and that's how much his cash changed. But now he's got to argue with the accountant. There's $60,000 more in taxable income according to Congress and the IRS. And that's where there's a continual battle back and forth and back and forth. Sometimes taxable income is lower than change in cash. But that's what we're going round and round talking about. And so that's where the rubber hits the road. The 2,600 is not incorrect. That's the change in his cash in his checkbook. But 62,000 is not incorrect. That's technically what Congress says he's going to pay income tax on, even after writing off the BMW and the kids on the payroll and the trip to Hawaii. Okay? Let's talk about break-even point real quick. I'm going to talk in terms of lower figures on the scale. You may be up at 900, 2 million, etc. But for our purposes, what this shows is, here's your fixed expenses, and on a chart, as we go from 150,000 of collections to 250 to 350 to 450, no matter where we are on this scale of how much we're collecting, does your landlord care? Does the telephone company care? Within reason, does your staff cost change much? You can change staff costs every 6 to 9 months or something, but day in and day out, most of you can't all of a sudden say, hey, let's fire 2.5 people for the rest of the day. No, it's going to be a pretty fixed expense. And so the graph shows there are fixed expenses in my example, it looks like, of about $110,000, no matter how much you collect. And in fact, before you turn the key in the front door, you already have hard fixed expenses of $110,000 for the period that you're going to be responsible for. But that's not all the expenses. We have lab and we have supplies, and if nobody showed up, we wouldn't have any lab expense or any supply expense. But let's say some people do show up. And so as our collections go up, notice the variable expenses, supplies, lab, etc., it's sloping upward to the right. It's increasing as our collections, our revenues, our work increases. So you've got variable expenses you've heard people talk about. You've got your fixed expenses. And if we add those together, you have this sloping line, but it does not start at zero. Okay? And so it starts at some place higher than zero. So let's clear these out. This is what your expense line looks like. Pretty high number, plus gradually sloping up because of the variable expenses. Let's compare that now to collections. I'm starting here, remember, not zero. Zero will be way back here. I'm starting at 150. Here's your blue collections, and it shoots up at a sharper angle. For every dollar of collections you earn, theoretically, if there were no expenses, you'd get to keep it. So collections are going up at a 45-degree angle, and notice where these 2 points cross. That's the break-even point, where your collections, about, let's say, $170,000, finally crosses the red line. That's your break-even. The break-even is still sloping up a little bit, so it's not a static line. But the difference between the collection line and the expense line is profit, because collections are going up faster than the variable expenses. Remember I said when you get to that 4 o'clock patient in the afternoon, your rent's already paid, your phone bill's already paid, your staff is already paid. It only costs you a little bit of variable expenses, lab fee plus supplies for the most part, and so it's sloping up a little bit, but it doesn't start at zero either because of that rent and things, your fixed expenses. And so the higher you can go in your collections, look what the profit's doing, getting more and more and more. But let's look at an example. Let's say we're here at $300,000 of collections. Our profit, the difference between the two lines here, is $90,000. Let's increase collections by $50,000 to $350 from $300. The profit out here is all of a sudden $125,000. And look at the relationship. You only increased your collections $50,000 or 17%, but your profit increases by 40%. That's why we always had the argument, and you've heard years and years and years, get your fees higher. If we can move that blue number up a little bit, if we could get your fees increased 17%, your profit would go up 40%. That all drops to the bottom line. And so if your collections are going up, that's a good sign. And that's why bigger is better. However, let's see what happens if we have a 30% PPO fee cut. Here's our original collections. Here's our original break-even. But let's see what that does with a 30% fee cut, and we pull this dotted line down 30%. Look where your new break-even is. It's way out here somewhere. And here's why your overhead looks so high, especially, and it is high in reality based on your collections, because you're way out here at this break-even point. One more reason we beg you to seriously consider getting out of the PPOs, because this 30% fee cut drops straight to the bottom line and comes out of your profit. The landlord doesn't want to hear about your PPO reimbursement going down. Your staff doesn't want to know. The phone company doesn't want to know. The expenses still stay the same, and you're stuck in a rut here that it's tough for you to get out of. And so that's why we love to have that conversation with folks who are even halfway interested and should be interested in getting out of these PPOs. And so this is DentaMetrix Pro. It's a practice management software that we extract the information we've been showing you and the cash flow versus profit, but also we get into patient management, looking at a smart daily huddle, that shows you what's the outstanding treatment each day for each of your patients, so you can focus your attention more on having a conversation about getting those accepted and things like that. And so we left you a little bit of room.
Here we go. Yep, you did. I want to thank you for that. The great presentation, as I knew you would make it. I've heard you speak. I was hoping you'd sort of channel or invoke Cletus at some point, your alter ego, but I guess that's for another presentation.
That's right. Maybe another time.
Maybe another time soon. But I also want to thank you for the complimentary offers that you're making. You want to just quickly explain a little bit more about what you're going to respond to people who express interest?
Yep.
With?
So shoot me an email and tell me what you would like. I want to give you a copy of that cash flow report. That's just a fancy Excel spreadsheet, and you can build one yourself or copy mine, whatever, and build a cash flow report. But the principles are there for you, and you and whoever your guru is in Excel could do that. And I wanted you to change your QuickBooks so that it has functional categories, personnel, facility, etc., not just alphabetized, but also go ahead and do what the practice transition valuation folks do and carve out some of those items that a purchaser really would not be expected to pay. That $10,000 trip to Hawaii.
And that'll go to increasing Ebitda, which is what they all seem to be interested in.
Yes. So I'll send you a sample QuickBooks chart of accounts. Please do not go beat your CPA over the head with this and insist that he use that. There are multiple ways, I said, to accomplish the same thing, but he can at least see we don't want no alphabetized expenses. We want functional categories. We'd love to strongly look at segregating some of those discretionary expenses so we get a true picture of the true overhead versus some of the other items, wink, wink, nod, nod, we're deducting, but they aren't really overhead for our practical purposes. And if you have any other questions to explain what was going on here, the comments about the children and things like that, shoot me a note. If you happen to call me, that's fine. Please leave a message if you don't get through to me. My system automatically assumes any call without a message is junk. I have to keep telling my folks that. I try to identify folks that I know so their name pops up with the phone number, but a lot of y'all I wouldn't know. And so please just say hello or something so I know it's a real person.
Yeah. All right. That's a reasonable request. And speaking of questions, why don't we go ahead and dive in? The first one, I think it was asked rather early, but I guess since it was asked, let's reiterate that you're not saying that the folks who attend today don't need a CPA, right?
Oh, right. I remember the complexity of the tax code, and the tax code drives your tax return, and that's what gets your attention at the end of the year. How much do you owe in taxes? And you definitely need a knowledgeable person doing that, and it really, really helps if they understand dentistry so they know what they're looking at. They'll know if a number smells funny or not. So, yeah, you need somebody, ideally, I would say, who has some dental experience. We would call it a dental CPA. We mean 50
and they're really fine
dentists, not just 3, including your brother-in-law.
Mm-hmm. Can you explain again why you leave out the doctor's fringe benefits when you calculate net operating cash flow?
That's why we wanted to try to get the true net operating expenses that we could compare from practice to practice to practice. That's the major real expenses. Everybody has dental supplies, etc. It could be you don't have rent because you own your own building. What a practice transition person will do is put in a replacement figure. What would it cost that new person to pay rent because they don't own the building? That type of thing. But we don't want to have all the nonsense in there of the trip to Hawaii messing things up and the 3 kids on the payroll. So that's why we took out the doctor, because some of you take a big salary and a very little profit share at the end. Some of you take a big profit share and as little salary as possible just to meet your retirement plan. So you're playing other logical games there that would mess up a comparison of apples and apples.
Okay. Notwithstanding the write-offs and other legal tactics that accountants can employ, if taxes are so complicated, wouldn't a flat tax be better?
Well, we'd all love to think that. The problem is, one, it would not be simple, and again, or it would be simple, and we don't like simple. I want to be able to decide when to depreciate something or not. And studies have shown that a flat tax would be maybe 25% of your income. And believe it or not, most of you don't really pay 25% of all your income now. You have some income taxed at 35%, but you have layers, like layers of an onion. Some income is taxed maybe at 15% in the lower levels, and some is at 0. Most of you will not pay 25% of your income in taxes, especially if the accountant can be doing things like the 3 kids on the payroll. A flat tax wouldn't care about that. You're going to pay 25%. And so Congress would probably never really vote that in because taxes do serve a purpose as they try to direct the economic engine of the country, speeding up depreciation, slowing down depreciation. That's their favorite area of getting their pet projects funded, things like that. So that they're not going to give that up most likely. But it sounds good. We think we'd like a flat tax, but even if it was possible, we probably don't really. It'd have to be too high a number.
Okay. I'm opening up. Yeah, this one I just came in, but I'm asking for some clarification. So let's move on to another question. I think this was in the context of the communication with patients about PPOs. If you have that verbiage available for that conversation, I would love it. I'm guessing this attendee is welcome to reach out to you directly for that, or maybe talk a little bit about that now, if you understand the question.
Yep, and I gave you the core, which was the trust factor. Most of the time, the practices that the big box boys that take every PPO conceivable, probably very little fee for service. I hate to say it, but most of the time, once Wall Street gets involved and wants their piece of the pie, they've simply got to game the system. If you take a 30% haircut off the top, if not 40 or 50%, there's no way you can recover from that and keep your economic situation the same. And so something's going to give. The last thing that usually gives is the doctor is going to fight at all costs that the doctor won't take home any less money. So something else has to give. So what happens? He has to give each patient less time, or unfortunately, he has to perhaps over-treat patients. That's why you'll sometimes see a patient come in for a second opinion where the big box boys down the street tried to cram a Reston into 2-millimeter pockets. They've got to game the system to get their revenues up to make a decent profit.
I will say that this is a delicate conversation which requires finesse and a good deal of practice to have. And so if you're planning to extricate yourself, what one of my fellow consultants calls a PPO exorcism, you do want to plan ahead in terms of the verbiage. And one thing I would just add to what you said, Rick, which I thought was great, is that when you have a conversation about your decision to leave a PPO, and this is the case that I'm hearing from many of my health partners, is that it's not just that they're taking a haircut and not able to provide standard of care treatment, which is good verbiage to use also at the rates that the PPOs are offering, but they're also dictating treatment. They're deciding what I can treat in many cases and what I can't, and they're downplaying my treatment recommendations. And I mean, whenever you want to communicate persuasively with anybody, you always want to think in terms of what's in it for them. And if you're,
Sure.
you're only going to get so far explaining to a patient why you can't afford to deliver care. But what they will understand is why the soon to be past relationship was curtailing their ability to deliver standard of care that they were trained to do. Would you agree with that,
Part
Rick?
of the argument, part of the argument too is most of the PPOs are not reimbursing for COVID and PPEs, and that's why a lot of folks, doctors, will say we're going to change our working relationship with the insurance company. They may not say we're, quote, dropping a PPO. We're changing our working relationship because we discovered their interests simply are not aligned with yours, patient, to do the best we can, like you say, with the treatment or with the COVID protection. They're just not keeping up with the time. So reluctantly, we're going to have to change our working relationship. And it's just like when I teach over at the dental schools, I tell them, if you want your car repainted, you can take it out to old Earl Shive. I don't know if he's still around or not. And for $99, you can get your whole car painted, including the windshield and the door handles. Or you can go to, in my case, Atlanta Collision Center, $5,000. Well, the guys that go pay the $5,000 scratch their head and wonder what fools would go pay $395 for a paint job thinking they're going to get something that's not going to wash off in 6 months. The guys paying the $395 think the fools paying $5,000 are crazy. But the $5,000 might give you a paint job as good or better than came out of the Mercedes factory versus the Earl Shive. And neither end of the conversation is wrong. Just recognize you're getting what you pay for. And so you're either going to get the best of the worst or the worst of the best. But we don't want the insurance company involved in that conversation because there's a huge conflict of interest to pay for that big building downtown.
Yep. Well, here's the last question we've got time for. I'll need to pick from these, and then all these other ones I will be sure to share with Rick, and he will definitely reach out to you directly with an answer. This one is, I think it's. He said, I'm opening a startup in a location with other 33 GPs. I think he means with 33 fellow practitioners who mostly don't take any insurance. For me to compete, I have to accept some insurance. What is your thought about it? How many insurances should I contract with? And I know that's a very open-ended question for you, buddy.
Right. As a startup, in reality, you're probably going to have to take a bunch of PPOs. However, I want you to write a big note on the door to the break room. On the back of that door, hang a big note and says, get out of all PPOs within 3 years. And I want you to keep looking at that. We're going to use the PPOs in the beginning because, frankly, some money in the chair is better than no money in the chair. Okay? But I was talking to a gal in Texas that has been in practice 2 years now from scratch, and she's getting ready to get out of the PPOs. You have to have a track record, though. They have to love you. You've got to have some people skills. They have to trust you. Otherwise, why should they believe you rather than the PPO? But it's a necessity in the beginning. But I want you to carve that in stone. Don't plan to be, in the PPOs forever. It's the lazy and the easy way to go. But after a while, all of a sudden your schedule is chock-a-block full. You're, quote, busy, rushing around, but you're not what I would call productive. And I compare that to trying to eat soup with a fork.
Yeah, I think it's a great piece of advice. You can view them as a sort of a benign addiction or symbiotic relationship to help you get established and to help cover expenses. But the idea of having a plan, knowing that this is not forever, will help you, I think, make the transition that much more successfully and sooner. Right. Actually,
and do that before you start living like a doctor. Right. What the doctor's supposed to drive, not a Toyota Camry. that's 7 years old, like you've been driving, they're supposed to drive the new BMW and run it through the corporation. Well, you're still paying for it sooner or later.
Still paying dues. Yep.
Curb the urge to get the big car, get the big house. The lower you can keep your break even, personal break even plus practice, the easier it would be for you to go cold turkey for 6 months almost if you had to take a hit. Drop in revenues, but your overhead's under control. You'll suck it up. For every 3 that you lose, you're going to gain 1 good patient, and you're going to produce 10 times as much on that 1 good patient than 3 patients who only want to spend $1,000 a year. Do you really want to practice full of people who will only spend $1,000 a year or whatever their insurance would cover? I hope not.
Nope. All right. Well, on that note, let me thank you again for a great presentation, Rick, and let me share with everybody else that in a few days you will receive an email with instructions on how to apply for your CE credit. And again, please note that the code for this course is WIL 042822. Little hint.
Don't forget the next month's course.
First 3 letters of Rick's last name and today's date, WIL 042822. You will need this code to request your CE, so please be sure to write it down. Now I want to invite you to mark your calendars for Thursday, May. What's that, Rick?
Yeah, I was just jumping ahead of you there. Go ahead.
Yeah, that's okay. Yep. I'll take it from here, buddy. You've done enough. I now want to invite you to mark your calendars for Thursday, May 26th at 6 p.m. Central, when my guest again will be Mr. Rick Willeford to continue our deep dive into practice profitability and cash flow management with Discover Revenue Opportunities and Plug Profit Leaks. At next month's presentation, you will learn how to use unique key performance indicators to do a profit leaks analysis to see where you may be leaving money on the table with PPOs. Rick will also distinguish between what you can do on defense and on offense to enhance your practice's revenues and your own quality of life. That all happens on Thursday, May 26th at 6 p.m. Central. Until then, this is Danny Bobrow, thanking you for your ongoing commitment to practice perfection. Goodbye, everybody.